Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. Many of you have been with me for that long, especially Mark Gross with CSSI. And, if you're looking to take down one of these assets, whether it is a mobile home park or storage or multifamily, any of the commercial assets out there, we can help you put the lending on it across the board. Now, if you're looking at, let's say, a portfolio of single family homes, we can do that too, but 1 to 4 is going to go residential. So we are commercial brokers. We've been doing this for 38 years. I've been in real estate for 35 years. I'm actually only 36, but listen, if you're looking at a deal and you're looking for some feedback before you put in an LOI, I say do it before you put in the LOI so that you're giving the right pricing to that seller. We're going to look at your T12, the rent roll, your underwriting. All of those should be in Excel. And then if there's a offering memorandum, then send that along and we will get you, your best lending is agency. Not all deals can fit into the agency box. So we'll look at bridge or we'll look at bank, we'll look at CMBS, Lifeco. Any of those we can get you some feedback for. Typically agency will be 48 hours. All right. So don't forget the Old Capital Conference is coming up in October 8th and 9th in Dallas. This is the place to find your next partner, your next vendor, maybe your property manager, maybe an attorney. They all come to the Old Capital Conference, and we're looking forward to seeing you there. Make sure you go and sign up for that because every month the pricing goes up. And then if you're looking for a bus tour, this Friday, bus tour is happening in Dallas, Old Capitol. There again, if you look at the emails that I send out every Tuesday and Friday, there's information about those events as well. And if you're not getting any of those emails, please let me know. I want to make sure that you are getting the recaps from the speaker that comes in on Tuesdays. You should get a recap email and a link to those videos. All right, let's hear from some of the folks in the room. These are the people that can help you. They've helped me. They can help you. Mark Gross, what do you got? How can you help us?
Well, I can help your clients or yourself with the cost segregation studies. I'm with CSSI. We're the largest firm in the country doing that. I work on all property types nationwide, including one of Jim's clients in Southern California recently. So I'll put my information in the chat for a free preliminary analysis. And if you happen to be attending the ICSC in Las Vegas next week, please stop by my exhibit booth. Thank you.
Excellent. Excellent. All right, Angel, can you tell us a little bit about what you're working on, how you can help us?
Yeah, absolutely. If you hear my kids screaming in the background, it's because nobody wants to take the shower first. Everybody gets clean at the end of the day, so I don't understand what the problem is. But they even had a wheel, and they just spun the wheel, and it chose Jacqueline, and now she's throwing a holy fit.
Don't fight it. Tell her in the morning.
Yeah. So anyway, we've actually got a lot of things going on. We are creating a property management company, which people are going to tell you that you need to have all of these huge numbers to do it. We are creating a third-party property management company with 160 units is where we're starting. Usually what happens is that the way that a property management company makes its money is by having a lot of units. And so the margin is very skinny, but over time you create more influx because you've got so many units under your management. So don't be afraid to start even if you're super small, and we can help you because we're just a few steps ahead right now. So that's probably our newest thing that we're doing.
That is fantastic. Now, what about what's coming up for you guys, your virtual meeting?
Absolutely. We've got our summit number 10. It's our virtual summit, and it is coming up in September. It is September 24th, 25th, and 26th. And we're going back to the old format where all the speakers are live. We're not doing anything pre-recorded. And it should be a lot of fun. It's usually 30 to 40 speakers. We have panels, a lot of interviews, and it's just a lot of fun, a lot of learning. And we're going to try and have as many different asset classes as we can. Because right now, like what you're talking about, Jim, like one of the things we're doing is we've pivoted kind of away from multifamily a little bit. And we're looking at a mobile home community development. We've already bought the land and we're putting in 104 pads, and we're learning something new with that too. So lots of new things going on and lots of learning, and that's what we're up to.
That is fantastic. Excellent. Excellent. All
Thanks.
right. I think that's all of the vendors that we have in the room, which leads us to a quick getting into our speaker tonight, because we are excited to have Jim Ross back tonight by popular demand, back by popular demand. There's not a lot of them that we get to have come back. They're like, okay, next, but not Jim Ross, not Jim Ross. Jim has been helping investors to achieve better tax efficiency through entity structuring, maximization of deductions, usage of tax election and special designation, and various tax advantage investing strategies. So he is with Provision LLC. He also prepares taxes for small businesses and their owners, including many multifamily real estate partnerships. Jim is also an avid baker when he can squeeze that in, and has successfully baked many fun and technically challenging pastries and other treats that he shares with his friends, family, and co-workers. So we are excited to have Jim back. He is a treat and always so helpful on so many areas where we need to be strategizing early before the end of the year. Let's not take the last minute to invest in some deals or put money into your 401k IRA. Get to know how and what you need to do before it is too late. So welcome, Jim. How are you?
Excellent. Thank you so much. I really appreciate the intro. It's so fun to be back. And I'm happy to come back anytime. Honestly, I always have a good time. So
Oh, good.
I would add a couple of quick things before we even get into like the meat of our discussion today. First and foremost, if you are a sponsor of any kind of a deal and you have K1s to get out, you need someone that knows how to do this. And it's tricky and it's complicated. And if you have your things to Provision, if you have your ducks in a row and your information's together and your books are right, and we have your stuff by February 1, you are going to have your K1s out on time. You will. And I talk to a lot of different sponsors. And right now I see a lot of firms out there struggling to get K1s out on time. And some of it might need to be that there might need to be a little bit of training between your CPA and you as the sponsor about how to prepare for tax time before tax time. Maybe let's set up some time in November or December and talk about, do we have all the data that we need to prepare K1s for your investors? Do we have the books, sorted out and correct? If I look at your balance sheet and it says that you raised, 3.7825 whatever of capital, but that's not the amount you say that you raised, then something's wrong. So we can plan ahead of time so that you have a smooth process in the spring and you get your K1s out on time. All the investors are happy. It's very automated and off you go. So that was point number one. For those of you who are sponsoring deals out there, you might need a guy to step in and help you have a better outcome with getting your taxes filed for the partnerships, getting the K1 sent out, and taking care of those investors. Number two, Julianne, next year, 2026, the Old Capital Conference, October 16th or 17th or 18th, please, because we file extensions and taxes are then due October 15th. October 8th and 9th is so hard. I will try my very best, but if you give me just one extra week, I would
Yeah.
be
Oh,
there.
you know what? Let's change it for you, Jim.
Can we
Right?
change it?
Yeah,
It's not
let's
too
just do
late.
it for you. No. Yeah,
Okay,
just for
good.
you. No problem. Which brings a question for me. I am with a deal that is being handed off to another group, and that next group is going to they put in it, we put in an LOI for them to, I guess, pull us out of the loss. We still don't have our K1s. So what is the deadline for a K1 for a property that is basically being sold? And we don't have those yet. How does that look?
Well, so you have multiple different kinds of scenarios that can play out. So the normal tax deadline for partnerships is March 15th, if it's a calendar year end partnership, which most of them are. So under normal circumstances, the year ends 12/31, taxes are due March 15th, but they can file extensions. So they can get a
Yes.
6-month extension. So then the extended deadline for the partnership is September 15th, again, under normal circumstances. There are goofy situations
Mm.
too, though, where, for example, a fund might sell a property, but they may not dissolve the partnership yet. So if they
Yeah.
sell the property in May, let's just say, but they keep the company and they maybe have some trailing expenses to sort out and stuff to figure out before they actually close everything down and distribute the last of the money out, well, they may still wait and file the taxes in the springtime, even though the property is sold. So you're not going to probably get a K1 right away. In fact, most of the time you're not. Um, unless they actually they may dissolve the entity mid-year, but then the tax deadline changes. So the tax deadline's 2.5 months after the end of the year. But if the end of the year is June 30, because that's when we closed it down, then they have
Mhm.
2.5 months from then to file it and send out the K1s, plus potentially another 6-month extension. So it depends, but yeah, it's
So then for those people that are waiting for those K1s, then we have to also then extend our filings
well,
until
when
they,
was the property sold?
well, we have an LOI now, so it'll be probably 60 days until that closes.
Yeah. So the K1s you're talking about are going to probably be 2025 K1s, right?
Well, they
And
should be 24.
well, not if it's not been sold yet.
Correct, but I still don't have my 24
Oh, you
K1s.
don't have your 24 K1s. Well, then they're
Nope.
probably late.
They're
Yeah.
late, but
Um,
now it's being sold. So now how do I file my taxes?
well, they still owe you a 24 K1 that isn't going to have the sale on it, right? Because the
Correct.
sale's happening in 25. The 24
Correct.
K1 is just going to show whatever happened in 24. And again, they may have filed an extension in March, which they may have until September 15th to get you your
Okay.
K1. And then you have until October 15th to file your personal taxes. So you get a lovely 1 month buffer between when they have to give you the K1 and when you have to file your now
Okay.
extended
So
tax
there,
return.
so the sale doesn't affect that. That makes
No, no,
sense.
no, it
Okay.
doesn't. That's a
Okay.
25 issue. Yeah.
Yeah, that's right. That makes sense. Okay. Well, that also brings up the question, and there are some people probably in the room that are either having to deal with something like this or have heard through the grapevine that there's a lot of people that are losing money. And if they put the money into the deal and they haven't gotten any distributions, they've taken their K1s over the last 2 or 3 as losses, and then now it goes into foreclosure or it gets sent back to the lender
Hmm.
to sell
Hmm.
it, to take it over. How do those, how do they have to do any changes on their taxes? Will that affect them negatively?
Yeah. So the first thing that I always kind of want to remind people about in those kinds of circumstances is what your tax capital account means. Okay. When you get your K1, in the bottom left corner, you have what's called your tax capital account. When you put your $100,000 investment on day one, your capital was $100,000. But every year that that partnership goes forward, your tax capital changes. Okay. If there's profit, it goes up. If there's loss, it goes down. If you got distributions, your capital continues to go down. So let's suppose in your scenario, you had losses in year one and year two and year three. Your tax capital account's gone down, 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 and with it, your basis in the investment. Okay. So let's suppose you had started with $100,000, but now your basis is 10. Okay. They probably took a cost seg loss in year one. That brought your capital way down. You got a big fat deduction in year one. And then year 2 and 3, more losses, continues to pull your basis in that investment down. If your basis is now $10,000, that's the maximum probably that you're going to be able to write off, even though all your money's gone, right?
Mm.
So if you have capital left in the fund and it closes up shop and there's nothing else coming your way, okay, in the final analysis, you can basically write off the rest of your capital that you haven't already gotten a tax benefit for, but it may not be that much. So that 10 might be a capital loss at the end of the day when the thing is, it's all said and done. The company's closed down. There's no more money coming. Okay. And you kind of have to wait, right? If they're still kind of struggling along and like they might give you a false hope that there's going to be a turnaround coming in that time frame. You might have to wait, but when it's fully done, you can write off the rest of your investment.
Now let's take, for instance, it was doing well for 2 years and you showed that as well, you'll show it as a loss, right? But then what about the recapture? And taking that same scenario where we got distributions for a couple years, it got shut down because we're on a bridge and we had to put some money in reserves for our rate cap, and now we're losing it.
Mm-hmm.
What is the reversion on that taxing
Yeah, so
complications?
recapture usually has to do with a scenario where, because you took big depreciation losses against the asset, if you go and sell that property later, normally you have a capital gain if you sell it for more than what you bought it for. But if you wrote the asset down with depreciation and then you sell it later, you might have some of that depreciation come back as income that's, recapture income to pay tax on. And what you're going to have to look at there, and it's situational as far as like how far down did we take deductions versus how much income did we get over the course. Okay. Sometimes what happens is your capital might actually be negative. Okay. So you put $100,000 in the thing and you've deducted more than that over the course because you got a great big cost segregation, depreciation losses earlier on.
Mm-hmm.
And you're allowed to go into the negative because there's debt in the picture, right? That debt, that qualified non-recourse line item that you see on your K1 that says, look, Julie's share of the debt in this deal is whatever, qualified non-recourse debt. That is enabling you in those earlier years to deduct even more losses than the money you put in. Well, at the end of the day, your capital has to go to zero. Okay. If your capital is positive and it shuts down, that's where we were talking about a minute ago. You're going to write off the rest of your investment. It's, $10,000 loss or something like that. But if you're in the negative, your capital might have to come up to zero, and that might be income. It might be. And so it is situational. We'd have to dig into it a little bit, go back and look over those K1s and figure out, what your basis is and see how it shakes out at the end. But sometimes that happens and people are like, it's a big put off. But think of it this way. If you wrote off $200,000 of losses, but you only put $100,000 in, you at the end of the day, it all has to equalize on your taxes, right? Mm-hmm. And so if you wrote off more than your money and there's nothing else coming back, you essentially got debt forgiveness at the end to get you back up to zero. And that's the part that you might have tax on.
And what is the tax percentage on that you would, everybody's different, but is that a federal and state? It's federal. Okay. And so federal is 20%?
In that scenario, I think you would have, you'd probably have a combination of tax rates that could apply there. But remember that federal income tax rates go up to 37%. So you could have some of it in that highest federal tax bracket. You might have some that's only at 25%. You might have a combination there. And if the property is in a state that has an income tax, there can be state income tax considerations there too.
Oh, so if you're buying in Texas and it has no state income tax and you don't live there, you wouldn't have a state income tax? Or would you then, if you're in Phoenix, you guys have state income tax? Mm-hmm, mm-hmm. Would that be, you'd have to pay that or no, because it's Texas?
No, you probably would, because residents of whatever state, they pay tax in their state on all of their, nationwide income.
Okay.
Generally
So it doesn't
speaking.
really matter the state that the asset is in.
Well, unless you live in Texas and the
Texas.
property's in
That's right.
Texas, because
That's
then
right.
in neither case there's a state income tax.
Okay.
Paula's like, yeah, Texas is great.
I know, right? Yeah. All right. Well, we're this is kind of a fluid conversation tonight. Those of you who might have some specific questions, we're live conversation with our industry expert, Jim Ross, CPA, and tax strategist. So, any changes in the IRS for 2025 that we need to be thinking about?
Yeah. So Congress is hard at work drafting up tax law proposal. Okay. In fact, they just put out was it yesterday or the day before? I think it was yesterday. The Make America Great Again, it's what did they call it? The one big beautiful bill. That's the nickname that I'm seeing for this thing. And it's basically everything under the sun that Republicans want to put into their tax law. Now, I've seen this enough times to know that this is a negotiation. Okay. And like with any negotiation, you don't come to the table with half of what you want. You come to the table with everything that you want, knowing that you might have to back off of the 100% a little bit. Okay. So they know that. We know that. Some of what's in here is almost definitely going to get cut out because they're asking for everything under the sun. And even a number of the Republicans have problems with this bill. Okay. Because it adds a huge amount to the deficit. It doesn't do enough for the state and local tax cap people that live in like California, New York, New Jersey, places like that, where they're capped at $10,000 on the salt tax limit, among a number of other hot button issues that they're going to negotiate about. With that said, I'd like to hit maybe a few of the highlights of what I saw browsing over it. Stuff that I think in the realm of entrepreneurs, small business owners, investors, that is going to apply to a lot of us. So let's see here. Okay, this one's a little bit different. They're talking about making tips and potentially overtime pay tax-free. And basically what they're going to do with that is they're going to say, okay, you earn X amount of tip income. You're a server, let's just say. And when you go to file your taxes, you're going to have a new deduction that offsets that. There's going to be some limitations on that. Folks that make a lot of money aren't going to qualify for this thing. So if what's a lot of money? Well, they think it's like $150,000. Okay. So, but if you're a server, you probably don't make that much and you're probably going to get that deduction. They are creating a new car loan interest deduction. If you have a car that you finance and it's made in the US, we're going to let you deduct up to $10,000 of car loan interest. Again, if your income's not too high. So that one's new and interesting. Let's see. We are going to lock in the doubled child tax credit. Okay, we doubled it in 2018 to $2,000. We're going to make that permanent. And then for the next 3 years through 2028, we're going to actually increase it to 2025 or 2,500. So you have kind of a temporary extra piece of $500 on top of the 2,000 that it's been for the child tax credit. So congrats to those of you who have kids. You're going to have a little bit of a benefit there. We're going to keep the standard deduction, which was, again, doubled in 2018, and then they've kind of inflation adjusted it every year since then. We're going to keep it doubled, okay, and we're going to tack on for the next 3 years an additional $1,500. And so, your standard deduction is going to be somewhere in the range of $30,000. Okay. So if you add up your charitable donations and your out-of-pocket medical and your state and local taxes, and it's not more than $30,000, guess what? You're going to take the standard deduction. Okay. So that's a benefit. That's going to save, a fair number of people taxes. The salt tax limit. This is one of those negotiating points. It's a hot button issue. What they did in 2018 is they said state and local income taxes. That's your state income tax, your real estate tax on your home, and your vehicle related taxes. Think about, if you have to pay registration taxes, get your tags. Okay. You add those together, those three. If it's more than 10,000, you don't get to deduct the amount over 10,000. You're only limited 10,000. They're proposing in this version to make it 30,000. 30,000. Okay. And that's one of those ones where a bunch of congressmen are trying to make it a higher threshold. Okay. Because if you live in California, New Jersey, New York, where state income taxes are quite high, you can only deduct 10 on your federal. It's not very much. Okay. And it's disproportionately hurting people in those states compared to states like Texas, where it's just going to really be your real estate tax. Okay. Let's see what else here. They've created this new thing called Money Accounts for Growth and Advancement, aka MAGA accounts. Okay. And that's basically a tax favored type of account to benefit children under 8 for education, small business investments, and first home purchases. Kind of like a tax deferred savings account for young kids. There's even a part of the proposal where they're going to put $1,000 in it if your child is born between 2025 and 2029. So we'll see what actually comes of that. This next one I really like. Okay, small business owners, you have partnerships or S corps or even sole proprietorships. Tax Cuts and Jobs Act said you can take 20% of your profit and you can write it off as part of what we call QBI, qualified business income. Okay, or you might hear it called 199A. That 20% is not only being made permanent, but they're adding it to, or they're making it 23% in this proposal. So that would be an additional savings for small business owners to get to write off more of their income against tax. So 23% for pass-through businesses. R&D, if you have a business that's in research and development, in the last few years, we've had this situation where your R&D costs were required to be amortized, meaning you couldn't write off your R&D on day one. You had to spread out your R&D expenses over a long period of time. They're bringing back 100% expensing of R&D costs. They're bringing back 100% expensing for bonus depreciation. So,
when they are.
Well, in this proposal, yes.
Proposal.
So, and from what I'm reading, it may be capped, through the end of 29. Okay. But for the next several years, 25 to 29 at least, you would have in your apartment deals and other real estate types of deals, guess what? All your furniture and fixtures, the land improvements, okay, all the categories of assets that you get your cost seg report and it categorizes out your assets. If the categories are under 20 years, it would be in those categories where we could expense 100% of those assets on your first year tax return. So it's in 2025, as it is without this proposal, it's limited to 40%. So we're going to go from 40% to 100% if and when this goes through. Okay. I think that piece in particular is going to stick. I mean, there's no way for us to know that, but I think that one's a popular one. It's going to be some of these other ones that they have to give up on.
Do you foresee that being able to look back? And
if you asked me 6 months ago, there were hints that could be the case. I don't think that's going to be the case.
Oh, really?
Yeah.
Okay.
I think going back like to the beginning of 25, but into the prior years, like 24, 23, there was some talk about that we might have it go back that far. It's not looking like that as of right now.
Okay. Good.
Okay. So I have had a lot of clients this year in particular say, hey, let's file extensions. We see this tax bill stuff coming. Let's hold off. Let's just see if they give us something before we file 24. Okay. Because then we won't have to go back and amend and all that. And we'll just put the tax benefits on there when they come. I think that's not going to be the case here. So you're probably okay to go ahead and file 24, assuming if you have all your K1s, right? But if you're buying new property this year, you probably have, 100% bonus depreciation benefits to apply. Okay. Let's see. You remember when they started sending out K1s for people using Venmo and PayPal? There's some discussion about removing that requirement so that 1099Ks aren't sent out if your Venmo account had more than $600 go through it. PayPal, similar thing there. There's one of the proposals proposes removing that requirement, also increasing the 1099 filing requirement to $2,000 from $600. So if you pay contractors out of your business, normally if you pay someone over $600, they probably have to be issued a 1099. They're talking about increasing that to 2,000 again, just to give relief to small businesses, reduce paperwork, all that kind of stuff. Mm-hmm. The estate tax thing, that was another big thing, and it's again subject to negotiation here still. Right now, if the Tax Cuts and Jobs Act were to just expire, and if they did nothing, we would have a reversion of estate tax thresholds back to the much smaller thresholds, like $10 million. Right now, the proposal is saying, nope, we're going to make the doubled amount permanent. You're going to have per person $15 million to exclude from estate tax. So, husband and wife, could have a $30 million estate passed to the next generation without estate tax. If, again, if that component stays in the proposal as it is. Renewing the Opportunity Zone program. Raise your hand if you know what Opportunity Zone is. Yeah, very cool. The thing we've had, the struggle with opportunity zones is back in 2018, they said, okay, you put money in an opportunity zone, you can defer the tax on the gain of whatever it is that you sold until 2026. Well, guess what? We're almost to 2026. Mm-hmm. They're making a new wave of opportunity zones in this proposal. They're basically saying, this will be round 2 of opportunity zones. It's going to run through 2033. So you put money, you sell something at a gain, you invest it in an opportunity zone. Okay, your benefits are going to be as follows. Number 1, you get to kick the can on paying the tax on your gain, okay, until 2033. All right, so you kick the can on paying tax on your gain way down the road. You defer that to later. Number 2, if you hold the investment in the opportunity zone for at least 5 years, you're going to get a 10% increase in the basis of whatever it was that you sold. Basically, you're permanently taking 10% of that gain that you had that's going to come back. 10% of it goes away forever, okay, after a 5-year mark. All right. And then 10 years in, however much gain you've accumulated in the zone, whatever the new asset is, okay, you sold something, you put money in the zone, it's a new apartment complex, let's say, and over 10 years in the zone, it's accumulating value. It's going up, 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 up. Well, all those 10 years worth of gains, you get to not pay tax on. Okay. So going forward after that, then, it starts to be like normal activity. You can accumulate gains, but the first 10 years worth of gains would not ever be taxed. Okay, so that's the benefit of opportunity zones. We had that back in 2018. It was set to expire at the end of the year, but they're proposing another round of opportunity zones. So I think that'll be interesting, to see how that kind of plays into commercial real estate investing in particular. That there was some incentive, of course, in the years past to drive money toward development, and we'll see, if that kind of heats things up in some of those areas. Last time around, though, basically they appointed governors, and the governor said, all right, we're going to do it there and there and there. Okay. And the idea was we're going to pick areas where, the economy's not strong, or where there's underprivileged families and things like that, lower income folks, areas that, just need to be revitalized because they're getting old and dilapidated. This time around, they're going to base it on census tracts. It's going to be very sort of statistical, based on, if the people in this area make below a certain percentage compared to the average around it, if they're basically less privileged than the others, those are the areas that are going to get these designations as opportunity zones. So I think it'll be better as far as it'll be less, kind of like favoritism. It'll be more empirically based. But again, we have to see. All this stuff is kind of subject to change. So all this stuff is, meant to kind of spur investment, provide incentives for business and development, and to grow the economy, to create jobs. It is, as it is, it has the potential to increase the deficit quite a lot. So that's one of the problems that they're going to be negotiating about, is a lot of the congressmen are not going to be okay with that, and are going to figure out, well, we are increasing the debt $4 trillion over 10 years or something like that. How are you paying for that? Or are we just, increasing the debt? And it, I don't know where we're going to land with that. But anyway, those were the hot button items that I pulled out as far as, stuff that's either new or revitalized, being enhanced in some way, that I think is going to relate to a lot of folks. Thoughts, questions, anything on any of that stuff?
I do have a couple things. On capital gain, is there anything that we're seeing? I know if you're out of your home, you rent it. It was your primary house. You rent it. Now, if you go to sell it after 2.5 years, you have a capital gains.
Mm-hmm.
Is that going to change at all? Is that going to remain the same? Married is 500,000.
I don't think so. I've not seen anything to that effect, suggesting to change that threshold. It ought to be inflation adjusted, right? Because it's been 500,000 for years and years and years. But yeah, basically what Julie's referring to is, if you lived in a home as your primary residence for any two of the last 5 years, at the time of sale. So you just, from what I sold it today, the preceding 5 years, if I lived in it as my residence for any 2 of those years, I can exclude from tax the gains subject to certain thresholds. If you're an individual, you can exclude 250,000 of gains. Married couples can exclude 500,000 of gains. And there are scenarios where, 3 years ago it was my residence and I had lived in it for a couple of years, and then it's been a rental ever since then. Well, 2 within the last 5, I met the requirement as having been there as a resident. It's been a rental since then. I can still exclude those 250 or $500,000 of capital gains, but I might have to pay tax on the depreciation. Okay. Once I converted it into a rental property, I had to start taking depreciation deductions on it. Well, those depreciation deductions can't be excluded from that convention in the law. So I have the depreciation come back as recapture income in that kind of scenario.
Okay.
But I might also, depending on how much the depreciation recaptures, I might look at 1031 exchange, because if I switched it to an investment property and I held it that way for a while, it could then qualify for 1031 exchange.
And you cannot do that in reverse.
Meaning, if it was a rental first and then my residence?
Yeah.
No, you could. Yeah, you could take a rental property, convert it to a primary residence, live in it for 2 years, exclude, up to those thresholds. But again, the depreciation amount has to come back as income.
Okay. And does it also have to be a homesteaded property?
No, it's just based on that you lived in it and it was your primary residence.
Understood.
Okay. What about, we talked a little bit earlier on the bonus depreciation, the cost seg for somebody who has a W-2.
Oh, yes.
How do they on the K-1s? How does that get?
Yeah, that's a great question. It comes up all the time. I've got W-2 income. I have property, and there's potential for significant tax loss there. If I have a cost segregation and I get bonus depreciation on it, what's going to happen as it relates to my W-2 income? Well, it depends. Okay. So you have to compartmentalize in your taxes your income categories. Okay. Your wages are ordinary income and it's active because you're involved, it's something that you participate in to generate the income. Your rental income, it's sort of by default passive, but in some cases we can treat it as active. Now that's going to depend on a couple of things. One of them being, how much time do I spend on that property? Most folks don't spend more time on running rental real estate than they spend on their W-2 job. It has happened. I had a client, this was years back. He was a pilot. He worked on kind of a contract basis. He wasn't in the air all the time. So he would just log the hours. I spend this many hours in the air. Well, the rest of the time he had like a dozen rental properties that he was running. And he actually spent more time doing that than he spent flying. So he could treat the real estate as an active business and he could offset the losses from the real estate against the wage income. So sometimes that can apply. It doesn't apply a lot. It might apply if your spouse is the one doing the real estate. Maybe you're the W-2 person, your spouse runs the real estate. And if she spends enough time, or he, depending on, what they are, they can, potentially take those tax losses and use them to negate tax on the W-2 income. So you have to look at how much time is spent on those two. I would want to, as your CPA, sit down and talk about, who's involved, to what degree, how do you log the time? Okay, this is the kind of stuff you have to log and document because the IRS goes after people sometimes that do that. Like, did you really spend that much time on the real estate? And obviously there's a big tax benefit to be had. So anytime that can be the case, you have to make sure you're audit proof. All right. So we'd want to look at that. Another kind of scenario that can play out is in the vacation rental realm. In vacation rentals, you don't necessarily have to spend more time on real estate than you spend on your active W-2 job. So you have to look in the vacation rental side at how long are the people staying there and are there substantial services being rendered? And a lot of times, like if I just kind of poll the audience of my clients who have short-term rental properties, the average rental stay is usually like 3 or 4 days on the year. If some people stay a couple of nights, maybe another couple stays 5 or 6 nights, but on the average over the year, it's like 4 or 5 nights. If it's short term like that, you may be able to treat it as non-passive as long as you're involved in the business enough. It doesn't have to be more than your W-2 in the vacation rental side, okay? Because that's not a rental business necessarily. It's a business. So you think on a spectrum like, okay, over here is a hotel, and that's very clearly just a business. And over here is long-term rental, right? Well, where does the short-term rental like Airbnb, Verbo property fall on that spectrum? Well, it can be kind of anywhere on that spectrum, but if it's closer to the hotel side because the stays are short, okay, and especially if you provide a lot of stuff there, like it's not just a bed, but guess what? You stock it with food and supplies, and there's Wi-Fi and satellite, and you have rental of bicycles, and the more stuff you add to that context is like the amenities and the services that come with it, the more you start to make it look like a hotel. And that's the kind of scenario where maybe that's an active business. Maybe those tax losses can negate the tax from W-2 income. It's very circumstantial, and the context matters, right? So that's where you want to sit down with your CPA and figure out, well, how do I make my context look like this? If it's tax beneficial to do that, you can work toward that.
So when you refer to having a spouse, that would be the reps indication. What do you call it?
Real estate professional.
Right, but it's just a notation on your tax.
Designation.
Yep.
Designation, that's the word I was looking for. Thank you. Yeah. Okay, perfect. Now, that kind of leaps into oil and gas. So we know that on the active side, oil and gas has a great tax deduction on your active. Maybe you could walk us through that as well.
Yeah. So again, we're talking about the categories of income in the tax law, and you have kind of active versus passive. And the active thing usually relates to how much involvement the person has in the activity. Okay. If you put money into an apartment deal and it's just an investment and you're not involved in running it all, okay, there's a sponsor team that you're not a member of, someone else is doing all the work and you're just getting distributions, that's a passive investment. Okay, that's how that's going to be categorized. Okay, and they're great. That's a lot of times what folks are looking for. But oil and gas is one of those exceptions where if you invest in what's called a working interest in an oil and gas development, okay, this is where they're going to go out and develop the oil and gas resource production. Okay, they're drilling wells and things like that. You can invest in a fund that does that, and without spending any time on it, you're not actively involved, but there's a section in the tax law in 469 that basically says you're invested in a working interest in oil and gas. You can treat that as a non-passive investment, kind of like a loophole almost. I mean, it's a carve out. It really is. It's like this would normally be passive because you're not involved at all, but you can treat that as non-passive. And so a lot of times I see scenarios, people put $100,000 into an oil and gas fund, and they may get an $85,000 tax deduction in year one because guess what? They're taking all the money from the investors and they're putting it into the assets to go and develop those wells. It's very capital intensive, and so they deploy all that capital, and everyone gets a write-off very quickly up front, okay, for the fact they've deployed that into assets, and they get to write that off against their other sources of income.
Do you see that happening a lot?
I see it all the time. I see it the most in like Q4. All right. Think about what happens over the course of the year. People aren't necessarily in like May thinking about what's my tax for this year. They might be doing quarterly tax payments if they're, a business owner and they're kind of on top of things. But a lot of times it's like October, November rolls around. Everyone's thinking, shoot, like how much have I made this year? What's my tax going to be? If I have capital to invest, what can I put it in Q4 to offset my taxes before the year is up? And that just happens to be one of the things a lot of folks look at because you can do it very quickly without any time spent. You're not, out doing due diligence per se. I mean, you're looking at the PPM and what the deal consists of and so on, but it's not like you're out looking to buy a multifamily property yourself. Somebody else is doing all the work, and they'll take your money and put it into work for you, and you get a tax loss like that. I mean, it's simple.
Yeah. Okay, you had mentioned business losses, doing business. Can we go over some of those, especially as a reps designation, how that can help? What are some of those areas that people forget. Home
Sure.
office, car. What does it has to be 5,000 or tons or whatever it is, right?
5,000 tons.
No,
That's the
it's
weight threshold.
two tons, 5,000 pounds, something like that, right?
Yeah. No. So what you're talking about is, okay, I'm a real estate professional. And so I have a business essentially. That's what I'm saying is I have rental real estate and it rises to the level of being a business. So I'm going to have business deductions. Now, take yourself out of the small business realm for a second. Okay. You're thinking about yourself sitting at your home office, running your little real estate enterprise. Put yourself in the mind of like, you're in Manhattan. You're in a skyscraper. You have a whole team of people. You're Donald Trump's real estate team. Okay. And think about how much property they have out there and how many people are involved in running it. And what are the expenses that they have? It's not just the expenses of the property, there's administrative stuff going on there. They have to have a space in which to run their business. That's your home office deduction. They have to have people going out and doing things. Well, that's your travel and your transportation expenses. They have meetings all the time and there's meals that are a part of that. That's your business meals expense. Just because you're small doesn't mean you're not entitled to the same tax deductions. So think big and then apply it to your circumstance. You could be Bob and Sue who own a multiplex down the road, but if you're owners of the business together, you could go and have a business meal. Okay. And in the context of sitting down over dinner and talking about the business, guess what? You take your little receipt, you put Bob and Sue talked about X, which is whatever the topic was about the business. That's your documentation for a business deduction. Okay. It's the same thing. If you go to a real estate conference, okay, and you're networking and you're learning, okay, well, what's the purpose of that in the business? Well, for one, if you're networking, it might mean that you're trying to drive revenue in the door. So there's sort of a marketing, advertising need for that kind of function. The other side is just sort of educational. Business owners in any kind of business have to stay abreast of what's going on in the industry, right? You have to follow the trends and learn new things, and otherwise you get left behind, right? So businesses need continuing education too. As a CPA, I have to have 40 hours a year of continuing education. That's required. But a real estate owner can also have real estate related education, and the expenses associated with getting it, whether it's on a webinar or traveling to Vegas for a 3-day real estate conference, those are the kinds of things that you might have business travel for, business meals while you're gone. You might have, Uber and Lyft expenses, okay, hotel expenses, flight expenses, okay. There's a business component to that trip, and you can make those expenses business expenses. All right. Just as another example.
So travel meals versus entertainment meals. I know that it's looked at a little bit differently. Can you kind of break that down? Is it better to have an entertainment meal
If you
than
can
it is by
avoid it,
yourself?
if you can avoid it, you'd like to not call it an entertainment meal. Okay.
Okay,
So
that's good.
couple of components to that. One being in 2018, okay, they gave a bunch of great tax benefits, but they took a few away. One of the ones that they took away was business entertainment. Even like used to be that you could go have a round of golf with like a potential investor or a business partner, or you could go to a ball game. You could have business entertainment if you're meeting with someone and there's business being discussed while doing one of those kinds of activities. Well, they took away that tax deduction in 2018. So
Okay.
try not to call it entertainment if you can, but you can still have a meal. Business meal is different. That's, we're sitting down and having food together, and there's more than one person. Okay. That's another requirement. There's more than one person, and there's a business is being discussed. That's a business meal. Travel meal is kind of another category. It's like, because I'm away from my home and I have to eat while I'm away traveling on business. Okay. The purpose of me being gone is business. So as soon as I've established that, and now that I'm eating in another town, those are business meals because I'm traveling away on business.
Now, isn't there a certain threshold that you're allowed on
Yeah,
those?
it's a 50% deduction. So you're going to give your CPA, you're going to give me the total amount that you spend. You're going to say, Jim, I had $1,500 of business meals. I'm going to take that and put it on your tax return, and it's going to automatically reduce that down to 50%. But track the full amount, have your company pay for the full amount, keep your receipts, snap a picture with your phone or whatever software it is that you like to document things with, and you'll get some tax benefit for that, and it'll be dandy.
Okay, so just let me recap that. If you're traveling by yourself, you're going to get 50%. When you're having a business meal and you're traveling, is it still 50%?
Yeah.
Okay.
The only time you're really going to have 100% deduction for like a meal is, let's suppose that you have, an office full of people and you bring in food for people to have while they work. That might be a different kind of scenario. But if you're out of the office and you're meeting with, your business partner or potential investor, partner, banker, lender, whoever it is, that's a business meal and it's going to be 50%. If you're away traveling, it's another business meal, it's still 50%. So most of them are going to be 50%.
Okay. Talk to us about the auto deduction.
Vehicle expenses. Yeah. So the key with vehicle expenses, it all hinges on the business being driven for business purposes. Okay. It doesn't hinge on how the vehicle is owned. All right. A lot of people misunderstand that. Well, I'll have the business pay for it and now I can write it off. Well, that's not really the case. What the law says is if you're driving it for business, that's what makes it business use. Okay. Even if you put a great big decal on the side, okay, Old Capital, right? And you're driving all over town out advertising Old Capital, that doesn't make it business use. You have to drive it for business. So you're going to take one of two deductions. You're either going to take the standard mileage deduction, right? Just however many miles you drove on business times the standard mileage rate. I'm not sure what it is right now, 65 cents, 70 cents, something like that per mile. And you get to deduct that on your taxes. Or number two, the actual expenses. Okay. The actual expenses is all the costs of owning and operating the car. If you finance it, it's the interest. You have gas, oil changes, all the maintenance, tires, insurance, etc., and depreciation on the car. Okay. Cars are 5-year assets typically. And so, you might have to spread the cost of the car over 5 years, but there are, bonus depreciation or section 179 deductions might apply and might give you more of that in the first year. When you said the 500,000 tons or whatever number you said, 6,000 pounds gross vehicle weight rating is the threshold. So it's usually like big trucks and SUVs. And all that's saying is over that 6,000 pound threshold is able to be given a bigger deduction in the first year. Right. So if you buy, a cool little Lexus sedan, great. If that's what you want to drive, or a Tesla Model S, cool. You might have to spread that out over 5 years. You can write off the costs either way, but the bigger vehicles are the ones that give you the more year one deductions.
So when you do drive a Tesla, you don't have gas, you hardly have tires because you don't, or brakes because you have the regen.
Yeah.
So it would seem to me like you're really only the option is how much you've driven.
Yeah, I mean, you're going to have a different mix of costs there. So you're going to have still depreciation on the purchase price, okay, which might be more compared to like a Toyota sedan of similar quality. I don't know, depending on what you're looking at. You have maybe costs associated with charging. Okay. So yeah, you're not going to have all the same costs with an electric vehicle.
So you have a solar system at your house, which is where you charge. So that's also not helping the situation.
Yeah, not really. No. I mean,
okay.
I guess the argument could be made that some of your electricity is a business expense there because it's going into the business vehicle. I mean, you could kind of prorate things, but it's probably not even worth it to go down that road.
So are you saying that you should just be holding your cars for 5 years and then get rid of it and get a new one for that deduction?
Well, not necessarily though, because when you sell a vehicle, even on trade-in, you have a sale. So whatever they gave you for the trade-in, that's income. So if you wrote off a $60,000 SUV and then 3 years later they gave you $40,000 for it on trade-in, well, now in year 3 you have a $40,000 chunk of income. Now you can trade in, and on the new cost, whatever the new vehicle is, you can take a new deduction on that. And usually because of devaluation, you have less income on the trade-in than your write-off on the new purchase. And so net, you still come out with a tax benefit, but it's not, this mind-blowing thing where, you trade in a vehicle all the time and you have another big write-off, because again, every time you get a trade-in allowance, that's income.
Okay. All right. Those are all
Okay.
the questions I had. Social Security, is it going away? Are we concerned about it?
We're
Is that
always going to be
something?
concerned about it. I don't see it going away right now. It doesn't look like they're doing anything with it of great significance. Uh, the question's always going to be there of, is it at risk and is it going away? I don't think so. One thing that I put a note in, Julie, just kind of thinking about sponsors here,
Mhm.
as it relates to the structure, one of the questions I get a lot is, in what case should a sponsor have, or would they have multiple entities of their own as they're sponsoring deals? Okay, a lot of folks just think, well, I'm Jim Ross and I'm sponsoring deals and I just have K1s come into me from the deals. Maybe I get a couple of K1s because I'm a GP and an LP. But should I have those go into some kind of an entity structure that's my structure? And if you're sponsoring, I think you should have probably a couple of LLCs. In fact, you might have one that's like your holding company LLC. All right. To the extent you have all your sort of long term hold assets, your LP interests in deals, I think you put that in a bucket with a holding company. And then to the extent that you're like a manager, GP, sponsor, this is the active side of things. You may have another entity that holds that piece. So when you're looking at an operating agreement, it's not going to say Jim Ross anywhere on there. It's going to say the name of my companies that are involved in the deal. The manager is such and such LLC. Okay. And that's also good for branding purposes too, because that company is going to live on from deal to deal, right? If I do 10 deals, I can take that same company, I can go market it out there and say, this is the company doing it. Old Capital, right? That's my brand. This is the one that you're going to see from one deal to the next. That's my company that keeps going. The syndications come and go every few years, but my company lives on. And the other reason that company might be important is because I may have employment tax considerations, right? Sponsors sometimes have active income. If you're getting promote fees, acquisition fees, management fees, okay, that's active income. Well, you might have to pay self-employment tax on that income. So this company over here, that's me as an active person in sponsoring, that might be an S corp. Okay, so my active income rolls up into the S corp. I pay myself a small salary. The rest of what I make doesn't get hit with FICA tax. That's the whole point of S corps, and all the passive stuff goes over here into my other holding company. Like, that's the kind of stuff that is like, especially new sponsors, they haven't always figured that out yet, or it's lost on them, or maybe they don't have a guy in their life saying, "Hey, man, you need to, you got to have," and you compartmentalize for liability purposes too, right? Who's like, if something goes catastrophically wrong on a deal, or like what we're seeing with some of these deals right now is they're going belly up. Well, who do they point the finger at? They're going to go to the paperwork and it's going to say Jim Ross all over the place, and they're going to start coming after Jim Ross. Well, ideally, it's such and such LLC, right? That's what's on all the paperwork. And what does that company own? It doesn't own anything. Okay. Limit your liability as a sponsor by using LLCs instead of putting your name on everything, right?
Makes
Yeah.
sense. Makes sense. Okay, I think we have some questions here. Is it being set up into, okay, that was a question. So they call that 100% bonus depreciation. Is it going to be written in under a different kind of setup? That was Angel's question.
Yeah, my thought was is like, so it was called 100% bonus depreciation before. Have they put it under like a different kind of program so that it doesn't have the same sunset as it did before because it's part of this different program now?
Nope, they're
Mm.
literally going to go into 168K and they're just going to change the language that's in there. If you look at what the proposal says, it says go to this section, replace this wording with this wording, and replace this wording with that wording, and they're just going to revise what's there. Good question. And that's what makes reading the proposals such a nightmare, because they don't come right out and say, this is what we're doing. They say, refer to section so-and-so and then replace it with this and refer to that subsection, this subsection, and you get kind of lost in it. Fun stuff.
Pre-production. Paula, we can deduct all the expenses we use to run meetings for real estate, like lunch, life, yep, landscaping, restrooms, security. So is that in a business?
That's in your home that has
In
a
your
business.
home? Okay.
Yeah, but my question about the pre-production was about the equity in the oil and gas business, Jim.
Okay.
So when I see raises, people are asking us to give money pre-production, and then and sometimes they call it or sell it as a syndication. But then once you start producing, then people look for royalties maybe. And so I'm always reading the fine print and like, is there going to be a division order somewhere? Because if there's not a division order, I don't want to talk to them. I'm serious, because they hide in this language, and I've been taken before. And so in the raise pre-production, I see that as a chunk of the equity. But then you got to read the fine print, right? Really, really closely to see what are they promising. If they get production, are they going to make a plan to give a DO or not? That's my bottom line. So that's what I was going to ask you about with that section 469 that you were talking about. I think you said 469 or 169, that they were getting stakes of equity stakes that they could write off as an equity stake when they were raising money. Is that correct?
So they do have an equity stake. Okay.
Yeah.
You're investing capital in the partnership that's going to go and do the development. Okay. And so, your $100,000 investment buys you X amount of equity based on your percentage of the capital that was raised. And that's going to determine, according to how much expense the partnership incurs in developing the wells, you get that percentage of those deductions attributed to you on your K1.
But every deal is different. So you really have to read it.
Totally.
Say
that's always going to be true.
You're getting the money, and then we're going to cash you out, and we take the equity with us as soon as we start production. And then in some cases, it may say the opposite. It may say, oh, at production, we're going to give you a DO, and you're going to, have an assignment that you have to, file with the county clerk's office. And then in 2 months, you'll get this, microscopic percent or whatever. And then come to you, whatever is in the future that it produces. So I'm just saying that we got to really read the fine print on what we're getting. So
yeah. And in particular, if I'm investing in something, the first thing that I want to know is, what are the sponsors coming away with, right? What's that split, right? Because some of them are really greedy, and the more greedy they are, the less likely I'm going to be to put money into it. Okay. And so you have to be careful about those allocations. How are they splitting profits down the road? Who's entitled to distributions when distributions are available to be distributed? All that stuff has to be scrutinized and thoughtfully reviewed. Yes.
Yeah, they can be greedy if they're taking the risk. Because I've seen them lose $250,000 a day by blinking. So after 4 days, you're like, I think we better have a different plan. So yeah, I say if they're taking the risk and they want to be greedy, that's fine with me, as long as everyone has got proper disclosure about that greed. So anyway, thank you.
Sure.
Anybody else have any questions for Jim?
Yes, I have one.
Sure.
In reference to the Augusta rule, can you speak on the Augusta rule? And
sure.
if you do use the Augusta rule, does that affect your home office?
So what he's talking about, the Augusta rule, which is a nickname, actually, it's not, there's nowhere in the tax law that says the Augusta rule, but it basically refers to a section of the guidance that says, all right, sometimes you have properties that are mixed use, right? I may live in them and I may rent them. And how do I treat that on my taxes depends on how much I rent them versus how much I live in them. All right. And the threshold there that the Augusta rule applies to basically says, if I rent my home out, basically it's my home regularly and most of the time, but occasionally I rent it out. And if the number of days I rented it out over the course of a year are 14 or less, that rental income from renting it out is not reported on your taxes. So it's non-taxable income. All right. As long as you rented it out for 14 days or less, that's non-taxable income. It stems from the golf tournament. Okay. People will rent their houses out for just a short time for the tournament. And we didn't want to muddy the waters and make everyone prorate everything, for 6, 10, 12 days, whatever it was. Okay. So we just said, all right, under 14 days, don't even bother. Okay. Now, how does that apply with business owners? Sometimes business owners will make the case that all right, well, let me give you an example. I have a dentist client in Illinois. If you go to this guy's dental office, it's kind of tight. Got a very small reception area, a little desk with a gal that, sees people when they walk in. You go back and there's, a few rooms where he sees the patients in and a little tiny kitchen. Okay. Now, what if as a business owner, he needs to have an annual shareholder meeting? What if he wants to have a company holiday party? Okay. What if he needs a space to have kind of like a special purpose event or meeting that his ordinary space at work doesn't work for him? Okay. So what's he going to do? He's going to rent a conference room, or he's going to rent a private room at a restaurant or something like that. All right. But instead, maybe he'd rather just have it at his house. Okay. So he has the holiday party at his house, or the annual shareholder meeting, or maybe he does it quarterly. Okay. And what he does is the individual homeowner, charges the business fair market rate for renting that space to the business. Okay. So if renting a comparable space, if the business would have paid a restaurant or a hotel for a conference room, $1,500 to have an event, he has the business pay him individually the same amount. Okay. And if the number of days over the course of a year that he does that is under 14 days, then he's under that threshold. He's not going to report the rent income that he personally received from the business. Okay. So the business deducts an expense for renting an event space, but the owner of the home, the individual, he's not reporting the rent income. Now, in my opinion, that's a separate world from, on the day to day, I have a home office where, a small subset of my house is where I do the functions of my business. And that's the day to day kind of stuff that, all day, every day, I take, I use that space for my office, and there's no rental agreement there. You don't have to have a rental agreement to take a home office deduction. There's no income, there's no rent. It's a different subset of the tax law. So in my opinion, you can have a home office deduction and you can use the Augusta rule. They're just separate reasons for the usage of your space.
How long would you use that? How long would you have a Augusta rule, a thing going on in your home? You'd have it one day.
Yeah, for a day, but you would do it several times over the course of the year.
Got it.
Mm-hmm. Maybe you do it once a month or once a quarter, or yeah.
Got it.
It can be quite substantial.
Yes, I think I've used that in the past, but I didn't realize it was in my home. I thought it was somewhere else. Okay, very good. Thank you. Angel.
All right, so I have a question about oil and gas. So you get your 80% in year one, but after year one, it's still producing, you're still making money, and it can get substantial.
Hopefully it is. Yeah.
Our 2024 estimate was like 7 times what I made as a teacher.
Okay.
It sucked.
Well, congratulations.
And so we bought a Sprinter van, but we bought it in January and we needed to deduct it in 2024. And so it's a commercial van, so like we get the higher deductions on it, but it's still like
it's a different tax year.
Do you know any tricks that you could still mitigate the earnings on oil and gas after year one beyond the 20% you get in year two?
Well, any kind of non-passive deduction could offset that. So if you are a real estate professional and you run some kind of real estate business, you may have tax losses there. If you're a consultant or, small business owner of whatever type and you have tax losses there, it could offset that. Could be that you make another investment in oil and gas. You have additional, tax losses from new investments in oil and gas. Years ago, I prepared Robert Kiyosaki's taxes, him and all his businesses, the rich dad guy, right? And what you would see from year to year is he had these sort of staggered situations where it's like, yeah, the first set of oil funds were kicking out a bunch of revenue, but he kept putting more in, as he went along. It's a deferral. It is, right? You get a great big tax loss in year one, and then you get income later, but you've kicked the can, at least temporarily.
Yeah. Well, and then when we get a dump in December, we're just effed. Like there's nothing we can do. We don't have time to prep for that.
I'm with you. Yeah, it's definitely tricky. Sometimes the timing is not advantageous.
I was hoping
that sounds
for a
horrible.
trip.
Sounds horrible.
Well, I have seen people put money into oil and gas on like December 27th, December 28th. So sometimes, there are funds that can take your money very late in the year. I've seen people put money into opportunity zones very late in the year. I've seen people buy business vehicles on December 31st to get the write-off in. If you get a big chunk of money and then there's not enough time to do something with it, that's very tricky. So then you might be looking at, well, should I, if I have a small business, maybe I am doing an after year end retirement contribution, after year end health savings account contributions. There are a few things that you can do after year end for the prior tax year. It's usually in the realm of, socking money into one of those tax deferred types of accounts. And some of them, you can put like $60,000 in after year end for the prior year's tax. So it can be, kind of like a last ditch effort to save a bunch of money.
Which leads me to talking about provision. Can you give us a little, hype up on your company and how you can help us and how we can contact you?
Yeah, absolutely. Provision's been around for 30 years. I'm one of 6 partners. We are headquartered out of Phoenix, Arizona, but our employees are actually kind of all over the place. We actually work remotely. I'm sitting here in my home office. If you want to come to Phoenix, great. We do have an office. We have a conference room. We can hang out or go out to lunch, but most of the time we meet just like this. Our clients are in all 50 states. Our niche is small business owners. If you have a small business of whatever type, it could be real estate, a lot of real estate investment clients, realtors and brokers as well, sponsors of syndications, but other types of businesses too, medical practices and dental offices and pharmacists and consultants and, anything. I've got farmer clients. Like if you have a small business, I can help you, make sure that you're structured well. Okay. Make sure you're getting all the deductions that you can get. Make sure you're documenting them appropriately. Make sure that you're, staying out of trouble from the IRS. Okay. And coach you to set things up in such a way that when tax time comes around, we've lowered your stress points a little bit. Okay. When you're a business owner and not just business owner, but especially business owners, okay, you have 3 big pain points with regard to tax. Number one, it's your biggest expense. For most people, tax is your single biggest expense. Okay. If you can even lower your tax 5 or 10%, you've blown your financial advisor out of the water. Okay. Your CFP is trying to get you another 1 or 2% maybe on your portfolio. If we could just do better than the S&P by this much, then we'll make our fee. That's what they're going after. Well, let us save you 5 or 10 or 20% on your taxes. It'll be way more impactful. Okay. So reducing tax. Number 2 is the understanding part of it. A lot of stress comes from people, just the tax law is confusing. It's complicated and no one has time for it unless you're me and you're really in it all the time. Okay. So leverage someone that gets it. Okay. To bring understanding to the table and reduce the stress from that, just like, I don't get it. Okay. And number 3 is, what if I'm missing out? What if I'm leaving money on the table? Right? What if there's something I could have done and I had a better outcome? And let's plan. Let's set a course to have a better outcome for you. So that's what we do. We work with entrepreneurs from all over the place. We'd love to help you out if you have a small business or, if you're sponsoring deals or even just your own thing, you've got a multiplex or something. We can make sure your K1s get out on time. We can make sure that you're not leaving tax on the table. If you have kids, we'll bring them into the picture, put your kids on the payroll, all that kind of stuff. So you need a yes man who's your tax guy, and we'll be there to help you out.
Excellent. Jim, how would someone get a hold of you if they had questions or wanted to start working with you?
Yeah. So you can go to provisionwealth.com. Okay. Provisionwealth.com. That's our website. You can also email me at james.ross@provisionwealth.com. I'm going to put all this in the chat right now. Okay. Put my phone number, email address. If you want to set up a no commitment chat, okay, we'll hop on a Zoom. We'll spend 20 or 30 minutes just kind of delving into what's your business made up of? What are your pain points? Where do you feel like you need, a better outcome? Let's spend 20, 30 minutes together and we'll figure it out. Okay. And look, if I won't hold it against you if after a half an hour you feel like you're good or you have another guy. I hope the other guys are good out there, but the biggest pain points I hear from people that have been with other guys is that they're just putting numbers on the form. I give them the data, they fill out the forms, off you go. The advice, the support, the strategy, that's what people aren't getting enough of. So, if that resonates with you, let's get together.
Fantastic. Well, you're always, always a wealth of knowledge for us. Whether you're here in the rooms with us live for this conversation, or if you're listening to this after, Jim always brings so much good information, and we always want to have you come back. So maybe before the end of the year, we want to have you back. We'll see, because there are things like Angel may have been able to think about, and you could have brought up to her, that might have been helpful. But maybe Angel, jump on a call with Jim. It might be your best amount of money spent and time, kind of figuring that out. So Jim, thank
Yeah.
you
And
so
by the
much.
way, I will not take anyone's money unless I feel like I can return it to you. Okay. I literally got off a prospect call just before this Zoom session, United Airlines pilot. And that's where we landed. We said, look, it's a little premature. You're just getting started. There's not a whole lot there. I mean, he's just a W-2. He's got nothing going on the business side, not enough opportunity for me to add value for him to justify my fee. I said, let's talk in 6 months. Let's talk in a year. If I can add enough value for you, then you'll be happy to pay me. Who's not going to pay X if they can save Y and it's more? Right. So and I'll be totally upfront with you about that. If I can't save you that much money, I'm not going to charge you.